Gold is approaching a major liquidity zone, and smart money, well, they might already be positioning before the next expansion move. Welcome to today's Explainer. Look, we're doing a high-level institutional market breakdown of XAUUSD today. We're going to synthesize the latest global macro data with precision, smart money concepts, and ICT methodology. The goal here is simple: map out the exact order blocks and liquidity pools the algorithms are targeting right now. We're removing the retail emotion. It's all about clinical, probability-based logic.
Right, let's jump in and establish the fundamental risk environment, because geopolitics are literally injecting massive volatility into global order flow as we speak. We just witnessed a sharp geopolitical pivot. US President Trump actually canceled planned military strikes on Iran, opting to delay things at the request of Gulf allies to push for diplomatic solutions. But here's the catch. Despite that de-escalation, the Strait of Hormuz, which is an absolutely crucial shipping artery, is still closed. And the immediate market reaction to all this? WTI crude oil dropped right back below the $102 mark. This kind of sudden pivot shifts global risk sentiment entirely, and it fundamentally alters how safe haven assets like gold get bid by institutional desks.
Now, zooming out to the macro level, we're seeing a huge divergence in central bank policy, and that's exactly what's driving institutional order flow right now. It's like a giant puzzle. Over in Japan, a BOJ official just confirmed their financial conditions are staying highly accommodative. They're keeping negative real interest rates in the short to medium term to support economic activity. But then, you contrast that with the Reserve Bank of New Zealand. They just held their rate at 2.25%, but man, it had a deeply hawkish undertone. And hovering over this entire global setup is the US Federal Reserve. Markets are bracing for the upcoming PCE inflation data, which is expected to come in hot at 3.8% year over year. This matrix we're looking at, this is the engine room of global dollar liquidity, and it directly dictates gold's overarching trend.
Digging into the economic calendar, that RBNZ decision to hold the official cash rate at 2.25% wasn't just some standard pause. The committee vote was split exactly down the middle. 3 members voted to hold, and 3 actually voted for a 25 basis point hike. It was so tight the chair had to cast the deciding vote. They are actively telegraphing that rates will likely need to rise sooner and higher than anyone expected justified inflation. But with that specific volatility catalyst out of the way now, smart money is fully shifting its focus to the US PCE data release. Make no mistake, that single data point is going to dictate the US dollar index's next expansion, and inversely, gold's next major sweep of liquidity.
But before we get into the technicals, we really need to talk about a massive anomaly happening in the physical market. $150. That is the rare, absolutely massive discount per ounce that we are currently seeing in India's physical gold market compared to the international price. It's a severe fundamental disconnect, and we need to pay attention to it. So why does this $150 discount even exist? Well, it acts as a fundamental drag on paper gold prices. India, literally one of the world's largest gold consumers, is going through a massive demand shock right now. The government slapped a heavy 9% import tax hike on the metal. But domestic prices have only gone up by about 4 to 6%, lagging way behind that tax hike. And the reason is simple. We're in a weak seasonal demand period, and there's ample physical supply flooding the market from people exchanging their old jewelry for new. In fact, the World Gold Council is forecasting a 10% drop in Indian gold demand for the year. To put that in perspective, that is 50 to 60 tons of lost physical buying pressure. Plus, historically, these extreme taxes just push people toward unofficial smuggling, which distorts the official data even more. Institutions know this physical drag is basically capping any sustainable upward momentum for the time being. All right, Section 1, Higher Time Frame Bias, Mapping Premium and Discount Zones. Okay, with those macro and fundamental realities dialed in, let's step into the top-down technical analysis using the H4 chart to build our macro bias. What we've got here is a really clearly defined overall bearish market structure. Notice how price just consistently fails to create higher highs and instead keeps breaking structure to the downside. The absolutely crucial level to keep your eyes on here is the 4510.34 area. By pulling our premium and discount arrays from the recent swing high down to the swing low, we can pinpoint those institutional supply zones. Remember, institutions do not buy in a premium. They wait for price to return to these premium supply zones before initiating any short positions. Right now, the algorithm's objective on this higher time frame is simply to rebalance inefficient price action before continuing its structural descent. Now, if we step down to the H1 time frame, we can start locating the actual fuel for the next move, and that is resting liquidity. Retail traders are always taught to put their stop losses right above double tops and below double bottoms. In our world, we call those engineered equal highs and equal lows. And right around that 4510.85 level, that's exactly where these massive pools of liquidity are resting. The algorithm is literally designed to seek out those stops. Before any true structural move can actually happen, the market's probably going to create an inducement, basically a false move to trap retail traders into going the wrong way, just before sweeping that resting liquidity. Our focus is zeroing in on these precise pools, because where retail traders see a breakout, institutional desks see the perfect exit point for their massive orders. Moving on to Section 2, lower time frame execution, order blocks, and smart money setup. So, having mapped out our higher time frame bias and those H1 liquidity targets, we can now shift focus to the intraday execution triggers on the M15 chart. Take a close look at those sharp drops and the consolidation phases that follow. What we're targeting here is the fair value gap, or FVG, that gets left behind during all that rapid institutional selling. Right near the 4510.24 level, there is a glaring imbalance in price delivery, and the market naturally abhors these vacuums, right? It's going to attempt to mitigate them. We are just waiting for price to retrace back into this N15 fair value gap and tap the unmitigated order block resting right above it. This is the exact, precise zone where smart money will look to execute their resting limit orders while leaving practically zero footprint. To actually capitalize on a setup like this, you have to stick to strict, mechanical, institutional trade logic. We don't guess, we react to algorithmic parameters. So here's the playbook. Step 1, exercise patience and wait for the engineered equal lows to be swept, purging that retail liquidity. Step 2, immediately watch for a change of character, or CHOCH, on the M15 chart. That's your first structural clue that smart money has reversed the immediate order flow. And finally, step 3, whatever you do, do not chase the breakout. You wait for the inevitable retracement, and you execute upon the mitigation of the newly formed order block. Following this protocol is absolutely crucial for high-probability entries with tight clinical risk management.
Look, as professional analysts, we always have to maintain an objective, probability-based mindset. So let's talk scenario planning. Our primary setup is the bullish mitigation. For this, we want to see that sweep of lower timeframe liquidity, followed by a really aggressive break of structure upwards, which lets us target those higher timeframe premium supply zones we identified earlier. But we absolutely must respect the bearish invalidation level. If price action just fails to respect the M15 order block and breaks our invalidation level with heavy volume, the trade idea is totally void. Scratch that setup. A break like that tells us the algorithm is bypassing near-term liquidity to hunt for much deeper discount liquidity pools further down the chart. We plan for both scenarios, and we simply react to what price delivers.
So we are sitting at a pretty fascinating crossroads right now. With physical gold demand plunging in key markets like India, but macro volatility and central bank divergence spiking globally, the algorithmic delivery of price is primed for a major expansion. The question you need to be asking yourself right now is this: based on the structure we've mapped out today, which liquidity pool will smart money target first? Understanding that sequence is literally the key to institutional trading. If you want more institutional style market breakdowns using smart money concepts and ICT methodology, make sure you subscribe to the channel. And hey, if you're looking to trade these exact setups yourself, you can open your trading account using the link in the pinned comment below. Trade safe, respect your risk, and always follow the liquidity.